Hi there and welcome. I'm Joe and you're about to start Hospitality Revenue Management, the Ultimate Exam Guide. If you're new to my content, I teach a range of quantitative topics like accounting, finance, economics, statistics, and a lot more through live classes and also on my YouTube channel. You can always visit joefirstyear.com for more information. Okay, that's my website. Now, why should you choose this course? I know the struggle, right? As a student, you're constantly looking for new tutors for every new course. Not only are you paying too much without knowing the quality you'll receive, but you also have to keep starting over with a new instructor. My teaching philosophy solves this problem. I break down complex topics into simple, repeatable blocks across multiple quantitative areas. To give you an idea of value, I offer many free courses on my YouTube channel, and some of the courses on my site are paid but still highly affordable compared to the high cost of unpredictable private tutoring. This approach ensures you grasp the material quickly and comprehensively, eliminating that constant search for a new guide. This course is built for hospitality students at any level. Whether you need a strong theoretical foundation or you're ready to tackle the advanced quantitative challenges on your exams. Okay? My commitment to you is to provide the why, which is the necessary theory, and also the how, which is the practical hands-on application. Okay? I call this the ultimate exam guide because it focuses entirely on solving the problems that matter. 80% of our time will be spent working live in Excel, okay? Tackling realistic exercises, the exact complex problems you will face on your exams, and also when you step into a revenue manager role. Okay. Crucially, the Excel workbooks with all the exercises will be shared with you along with the course. Okay. Over the next 6 focused modules, I will guide you through mastering critical quantitative areas like forecasting, group displacement, overbooking, and the powerhouse tool, which is Excel Solver for advanced optimization. Okay. My goal is simple: to make sure that you gain confidence to succeed in the classroom, crush your exams, and hit the ground running in your first industry role. Okay, let's look at the full course outline now. Here's a complete roadmap for the course, the 6 focused modules that will build your quantitative expertise step by step. Okay, we begin with modules 1 and 2, where we establish the quantitative inputs, KPIs for measurement, and demand forecasting to predict the future. This data feeds everything else. Module 3 covers our first major inventory decision, group management, where we master displacement analysis to find the MAR. Okay, we'll see what that is later. Okay, then we move into the optimization core, module 4. This is where we put our forecast to work using Excel Solver for linear programming and bid pricing, which is the ultimate allocation problem. Okay. Module 5 then applies the results of that optimization to strategy. Okay, we focus on net profitability, mastering the net RevPAR calculation, and analyzing EMRR and rate fences. Okay, finally, module 6 tackles the last inventory risk, which is overbooking, where we build the model to find the optimal level of capacity risk. Okay, this structured journey is designed to prepare you for every major quantitative challenge on your exam. Okay, this is a lot to cover, but I will guide you through every step. Okay, let's dive right into the details with module 1, which is revenue management foundations and KPIs. In this session, we are laying the groundwork. Our objective is to understand the language of revenue management and, most importantly, to measure our performance accurately. Okay, first, I'll take us through the essential theory, the 4 pillars of RM and fundamental operational metrics like RevPAR and GOPPAR. Okay, then we'll move quickly to the Excel application. The hands-on goal for this module is that you're able to solve exercises that calculate both internal profitability metrics and also external competitive indices, okay, like MPI, ARI, and RGI. We'll be looking at them later. Okay, mastering these metrics is the first step to make data-driven pricing decisions. Okay, let's start with the theoretical foundation, which is the 4 pillars of revenue management. Okay, before we jump into the calculations, we must understand the fundamental strategic framework. All of revenue management relies on these 4 pillars. Okay, first is pricing. This is more than just setting the rack rate. Okay, it involves determining rate fences and managing price sensitivity to ensure we capture the maximum willingness to pay from different customer segments. Okay, Second is inventory control. This is about managing capacity and availability using tools like minimum length of stay and close to arrival to protect high demand days from low value business. Okay. Third, demand forecasting. This is the bedrock of our strategy, right? If we can't accurately predict who is going to show up and when, the other three pillars will crumble. We'll dedicate a whole module to this later. Okay. Finally, distribution. This involves managing all the channels we sell through, constantly balancing the reach and volume that channels like OTAs provide against their cost. Okay. Our goal is to maximize net revenue after these channel costs are accounted for. All four pillars are interconnected and rely entirely on data. Okay, now that we know our strategic levers, let's move on to how we measure their effectiveness with KPIs. Okay, let's now dive into the three most fundamental metrics. Okay, these figures are the bedrock of our analysis because they capture the essential dynamic of revenue management. Okay, we begin with occupancy percent, our measure of volume. Okay, this simply tells us how many of our available rooms were successfully sold. Okay, high occupancy feels great, but focusing solely on it can be misleading, right? For example, we could hit 100% occupancy by selling every room for $1, which defeats the purpose of profit maximization. Okay, that brings us to our second metric, which is ADR, or average daily rate. This is our measure of price. ADR tells us on average what price we achieved for the rooms we sold. Okay, high ADR shows strong pricing power, but if we price too aggressively, our occupancy will drop and we leave money on the table. Okay, the third metric is RevPAR, or revenue per available room. Okay, RevPAR is mathematically the product of occupancy and ADR. Okay, it's the ultimate room only benchmark because it holds us accountable for both the volume we sell and the price we achieve. If our ADR is high but our occupancy is low, our RevPAR suffers. Okay, conversely, if our occupancy is high but our ADR is low, RevPAR still suffers. Okay, the entire challenge for a revenue manager is to find the optimal combination of price and volume that maximizes that RevPAR number. Okay, it's the best single metric for assessing how well we are balancing the market forces for our core room inventory. Alright, we now move from the combined success of RevPAR to measuring total revenue and, most importantly, profit. All three metrics on the slide share one critical constant denominator, which is available rooms. Okay, by dividing by available rooms, we hold ourselves accountable for the potential of every single room every single night. Okay, which is why these are the true measures of management efficiency. Let's use the simplified income statement to see where the data comes from and what each metric truly measures. Okay, RevPAR is our starting point. We already looked at it briefly in the previous slide. Okay, it uses the room revenue line item. Okay, it's a great metric, but it only accounts for the room itself. Okay, this is why we look at TRevPAR, total revenue per available room. This pushes us towards total revenue management by using the total revenue line, which includes food and beverage, spa, and all other types of income. Okay, this tells us what each physical room contributes to the property's overall top line revenue. Okay, as a side note, total revenue management also includes other metrics like RevPAR, which is revenue per occupied room, okay, and RevPAC, which is total revenue per available customer, okay, which help us shift focus from the room to the total guest spend. Okay, finally, the most accurate measure of success, GOPPAR, okay, or gross operating profit per available room. Okay, this uses the gross operating profit line item, which is revenue minus operating expenses. GOPPAR is what truly matters because it measures actual profitability per room. Okay, our ultimate goal is to always maximize this final figure. These three per available room metrics tell us where the money is coming from inside the hotel. Okay, now let's see if that performance is better or worse than our competition. We now move from looking inward to looking outward. Okay, it doesn't matter how high your RevPAR is if everyone else is doing better. Okay, that's why we use the competitive index system. Okay, this system starts with the competitive set, or in short, comp set. Okay, This is the small group of properties we benchmark against. The entire goal of this analysis is to determine if we are capturing our fair share of the market. Okay, the benchmark for a fair share is an index score of 100. Okay, a score above 100 means we took market share from the competition. A score below 100 means we lost market share. Okay, the three core competitive indices are direct extensions of our internal KPIs. Okay, MPI or market penetration index measures volume market share. Okay, your occupancy is compared against the composite's occupancy. Okay, the second metric, average rate index or ARI, measures the price market share. Okay, your ADR compared against the composite's ADR. Okay, now the most important competitive metric is the revenue generation index or RGI. Okay, this measures your total revenue market share. Okay, just like RevPAR is the product of occupancy and ADR, RGI is the product of MPI and ARI. Okay, if you outperform in volume and price, that is you have high MPI and high ARI, your RGI will be very strong. Okay, it tells the complete story of your market strategy. These indices will be the focus on our hands-on Excel session. Okay, now that we have all the necessary theoretical formulas, both internal and external, let's jump into Excel and work on some practical exercises. Okay, we're going to look at this set of 3 exercises that cover KPIs. Okay, we'll start with the first one. Use the information provided below to calculate the ADR, occupancy percent, revenue per available room, TRevPAR, GOPPAR, RevPAR and RevPAC for both years and calculate the percentage change from year 1 to year 2. Okay, you're provided a table with some information. Okay, hotel capacity, rooms that were sold for the whole year, total number of guests, room revenue, food beverage revenue, other operating revenue, and also your total operating expenses for both years 1 and year 2. Okay, we're gonna copy that, put it there so we can calculate it. We can use the space below here to calculate. Okay, so we'll start with ADR. Okay, ADR is the average daily rate, right? Okay, it's basically your room revenue, okay, divided by your rooms sold. Okay, so ADR for year 1 is 120 and the ADR for year 2 is 125. Okay, I'm going to link the formula here so you can follow along when you watch the exercise. Okay, and okay, so that would be C10 over C8. Okay, room revenue divided by room sold for the whole year. Okay, the next metric is occupancy. Okay, so we have the rooms sold, but how do we calculate the rooms available? Okay, we need to take the hotel capacity, which is the number of rooms, and we have to multiply it by the number of days in the year, right? Okay, let's say rooms available. Okay, so that would be your hotel capacity multiplied by 365. Okay, so that's your rooms available. Okay, so from there we can calculate your occupancy percentage. Okay, so it's basically your rooms sold over your rooms available. Okay, so you can follow along the formula here. Okay, so that would be occupancy. The next metric to calculate is RevPAR. Okay, so RevPAR, you can either multiply your ADR with occupancy percentage, okay, or you can take your room revenue, okay, and divide it by the rooms available. Okay, either way you should get the same solution. Okay, so RevPAR would be room revenue divided by rooms available. Okay, so that would be our RevPAR. Okay, the next metric is TRevPAR. Okay, so basically you need the total revenue divided by the number of available rooms. Okay, so we're going to do a sum of all the different types of revenues. Okay, so we have room revenue, F&B revenue, and also other operating revenue. Okay, we're going to take a sum of that. Okay, and we're going to divide it by the rooms available. Okay, so that would be our TRevPAR. Okay, again the formula, you can follow it here. And the next metric is GOPPAR. Okay, so that would be gross operating profit per available room. Okay, so first, gross operating profit is not provided to us, so we need to calculate that. That would be the sum of, okay, all the types of revenues, okay, minus the total operating expenses. Okay, so that would give you your GOP. Okay, from there we need to divide that by your per available room. Okay, so I'm going to put that in the brackets, and then we're going to divide that by the number of rooms available. Okay, so that would be GOPPAR. Okay, it's not a percentage, so you need to convert that into a number. Okay, and then okay, we're going to expand that for the next year too. Okay, we're going to expand the formula again. Okay, the next metric is revenue per occupied room. This metric can be a bit confusing if you are using it for the first time. Okay, you might be confused whether it's room revenue or it's total revenue. What does revenue really mean here? Okay, because earlier we distinguished room revenue from total revenue by using the T there. Okay, revenue per occupied room is always total revenue per occupied room. Okay, even though you don't see a T in the front, okay, revenue per occupied room is always total revenue, because just the room revenue per occupied room is ADR, right? We already have a metric for that. ADR is room revenue divided by the number of occupied rooms. Okay, so revenue per occupied room is total revenue per occupied room. Okay, so again we're going to take the sum of all our revenues, okay, and then divide it over the number of rooms that was sold. Okay, this is different from RevPAR. It's a bit higher than RevPAR, right? Because we are dividing it by just the number of occupied rooms. Okay, and the formula again is shown here. Okay, and the next metric is RevPAC. Okay, RevPAC is again total revenue per available customer. Okay, the customers who arrived at a hotel, okay, we want to use them to maximize our revenue by selling them food, beverages, and everything else that's available, right? Okay, so again we're gonna add up our revenues, but this time we're going to divide them by the number of guests that were staying. Okay, so that would be RevPAC. Okay. Okay, now we need to also calculate the percentage change from year 1 to year 2. Okay, I'm going to make that look a bit better. Okay, how do we calculate the percentage change? You can either do year 2 minus year 1 and divide it over year 1. Okay, or you can simply do year 2 divided by year 1 minus 1. Okay, it's the exact same formula written in a different way. Okay, and that would be the percentage change for all these metrics. Okay, let's make it a percentage. There you go. Okay, so the ADR increased by 4.2% from year 1 to year 2. Occupancy, yeah, we should show it as a percentage so we can see what that one entails. Okay, so occupancy had increased from 75% to 78%. Okay, and RevPAR from 90 to 97 and all the other metrics so on. Okay, GOPPAR actually went down by 4.1%. Okay. Okay, so that concludes exercise 1. Let's move on to exercise 2. Calculate the MPI, ARI and RGI for Hotel X provided the details of the comp set. Okay, you're provided that your hotel is Hotel X, okay, which has a certain number of rooms, occupancy and ADR is provided, and you're provided with a comp set, you're provided the same details, okay, but you need to calculate the indices for Hotel X. Okay, to start, we need for the comp set, we need to also calculate the average occupancy percent and ADR, okay, and then we need the revenue per available room for both the hotel and the comp set, okay. Let's try to calculate the occupancy for the comp set first. Okay, we can't simply average the occupancy of each competitor because the number of rooms in each competitor is different. Okay, so we can't just average the percentage. What we need is like a weighted average. Okay, so how do we do that? We can use the Excel function sum product to do that. Okay, we would take the rooms. Okay, each of the number of rooms is multiplied by the appropriate occupancies. Okay, and then we would divide that by the sum of all the rooms. That would give you the occupancy of the comp set. Okay, but if that's a bit complicated for you, okay, let's try to create another column here. Okay, let's call it rooms sold. Okay, where we're going to take the occupancy percentage of each individual competitor and multiply it by the number of rooms available. Okay, and we're gonna okay, these are numbers. Okay, so we're gonna so also a number, and these are the number of rooms that have been sold. Okay, so now we have a total rooms available, okay, which is the sum of all these. Okay, and we also have the number of rooms sold. Okay, let's see if the occupancy matches from our previous formula. So the occupancy of the comp set should be rooms sold, total rooms sold, okay, over total number of rooms available. Okay, so that would be again 70.3%. Okay, so you can see that this is a more intuitive way to understand, okay, if you're not sure how the sum product function works. Okay, okay, so how do we calculate the ADR? We cannot just average these numbers, okay, like I explained before, because the number of rooms is different. Okay, the most intuitive way to understand is getting the revenue, right? You can take the revenue by multiplying the ADR with the number of rooms sold. Okay, and then use this total revenue. Let's calculate the total revenue here. Okay, we use the total revenue and divide it by the total number of rooms sold. Okay, so that would be that divided by rooms sold. Okay, so that would be the ADR of the comp set. Okay, let's try to put that down. Okay, now how do we calculate the RevPAR for the hotel and also for the comp set? Okay, RevPAR would be, we know that it's occupancy multiplied by ADR. Okay, so that would be RevPAR for the hotel, and for the comp set again, you can copy and paste the formula here. Okay, so RevPAR is slightly higher for the comp set. Okay, now let's move on to the indices. Okay, we have MPI, we have ARI, and we have RGI. Okay, so MPI is given by the ratio of your occupancy with the comp set's occupancy. Okay, and we multiply it by 100 to make it an index. Okay, instead of a decimal, right? Okay, so an MPI of something greater than 100 shows that your occupancy is higher than the comp set's occupancy. Okay, what about the average rate index? You take your ADR divided by the comp set's ADR and then again multiply it by 100. Okay, so that gives you the average rate index, which shows that your ADR is lower than the comp set's ADR. Okay, and RGI again is RevPAR for Hotel X divided by RevPAR for comp set multiplied by 100. Okay, so that would be RGI. Okay, you can also reach your RGI by multiplying your MPI and ARI. Okay, let's try that. MPI multiplied by ARI. Okay, but in arriving at the MPI, we multiplied once by 100. To arrive at the ARI, we again multiplied by 100, right? So we need to remove one of those hundreds. So we're going to divide by 100 to make it an index which is comparable with 100. Okay, so again we see that it's the same regardless of whichever method you use. Okay, RGI is slightly less than 100, showing that Hotel X is performing a bit inferior compared to the comp set. Okay, let's move on to the final question in this module. Okay, question 3. Fill in the highlighted cells using the information provided below. Okay, you provided a table, okay, for Hotel X and the comp set for year 1, year 2 and the percentage change. Okay, you provided occupancy percentage, ADR, RevPAR, MPI, ARI and RGI, but a lot of these cells are missing. Okay, so we need to fill them with the information that has been provided. Okay, the most straightforward way is to look at percentage change and see if we can fill what's missing. Okay, so there are quite a bit of cells which have one value and a percentage change. Okay, and we're gonna try to figure that out. Okay, so the formula for calculating percentage change is basically that will be year 2 over year 1 minus 1. Okay, that would give you the percentage change. Okay, so we're gonna use that in calculating whatever is missing. Let's try for ADR for Hotel X. Okay, year 1 is missing. Okay, so we need to add 1 to the percentage change, and year 2, so bringing y1 to the other side, so y2 divided by 1 plus percentage change. Okay, so that would be y2 divided by 1 plus the percentage change. Okay, so ADR for year 1 for Hotel X would be 150. Okay, let's see where else we have year 2 and percentage change. We can copy and paste the formula, right? We have it here. Okay, so I'm going to copy and paste that here. Okay, so we got the ARI. We can also paste it here for comp set for occupancy percentage. Okay, but because this is an occupancy percentage, it's going to be a percent, not a number. And we can also paste it here for RevPAR for the comp set. So I'm going to copy the formula again and paste it here. Okay, so that would be the RevPAR for year 1 for the comp set. Okay, so that it's G9 over 1 plus H9. Okay, let's see if there is any other percentage change we can use. Okay, we can also use it for MPI here for Hotel X. Okay, so now we have year 1. So we need to, year 2's MPI would be 1 plus percentage change multiplied by year 1. Okay, so we're going to take 1 plus the percentage change and we're going to multiply it by year 1. Okay, so this would be the MPI for year 2 for Hotel X. Okay, so far we've just used math. Okay, we used percentage change and we filled quite a few cells there. Okay, now we're going to try to use what we learned about KPIs to see if we can fill the remaining cells. Okay, let's see if we can calculate anything with the information available. We see that we have RevPAR for year 1 for Hotel X and we also have for the comp set. Okay, using these two metrics we can calculate RGI. Okay, so we're going to take RevPAR for Hotel X for year 1 divided by the RevPAR for the comp set and multiplying it by 100. Okay, so that would be RGI. Okay, it's 100.1 because we're missing a decimal here. Okay, that's it. Okay, what else can we do? We don't have RevPAR for year 2 here and we don't have the percentage change either. Okay, so we're going to wait a bit. Oh, by the way, we have MPI and ARI for both the years, for year 2 too. Okay, so basically we know that RGI is the product of MPI and ARI. Okay, but the product is going to be not comparable to an index, so we're going to divide that by 100 to make it comparable. Okay, now we have both RGIs, so we can calculate the percentage change by year 2 over year 1 minus 1. Okay, so that gives us the change in RGI. We're almost getting there. Okay, we have the external metrics which can be used to fill in these cells that are blank. Okay, let's start with the occupancy. Let's see how the formula works. Okay, we take the occupancy for X. Okay, we divide that by the occupancy for the comp set and multiply it by 100 in order to get the MPI. Right? Okay, what we're missing here is the occupancy for X. How do we get the occupancy for X now? We take the MPI and we multiply it by the comp set's occupancy and then we divide it by 100. Okay, so that would give you the occupancy for year 1. Okay, let's see if we can use the same way to calculate the occupancy for year 2, I think we can just copy and paste the formula and it should work. Okay, yeah, so that would be the occupancy for year 2. And ADR for the comp set for year 2. How do we get that? So ADR for the comp set, so we know excess ADR divided by the comp set's ADR multiplied by 100 should give us ARI, right? Okay, so we have ADR for X. What we are missing is only the ADR for the comp set, and we have also the ARI. Okay, so we're gonna derive the formula from there. So we need the comp set's ADR. We're gonna bring it to the other side. So we're gonna have excess ADR for year 2, okay, multiplied by 100 and divided by ARI. So that should give us the ADR for comp set for year 2. Okay, the percentage change, I think we calculated that here. We're going to copy and paste the formula here. Okay, it's negative 11%. We're missing the RevPAR for year 2. Okay, again we can use the RGI index for that. Okay, or we know that we can also multiply the occupancy with the ADR, right? Okay, so RevPAR would be occupancy multiplied by ADR. And the percentage change again. Okay, there are several ways to arrive at the solution, because you know these formulae are all interrelated, right? Here, when we calculated the 138, again we could have used the occupancy percent and the RevPAR. Okay, divide the RevPAR by occupancy percent and we would have gotten that. Okay, so there are different ways to arrive at the same solution, because these 6 formulae are all interrelated. I'll share this Excel workbook with the course, okay, so you can download that and try to solve it yourself too. Okay, that concludes our hands-on session for module 1. Okay, we successfully moved beyond just the theory and solved practical exercises covering our core operational metrics. Okay, and we mastered the calculation for competitive indexing. Okay, MPI, ARI, and RTI. Okay, thank you for following along with the exercises. Remember, the true value is applying these formulas yourself, so keep practicing with your exercise files. Okay, now let's look ahead to module 2, which is demand forecasting. The biggest challenge with the data we just worked with is that it's historical. Okay, revenue management isn't about just reporting the past, it's also about predicting and optimizing the future. We need to accurately predict how many people are going to book and in which segment. Okay, in module 2, I will guide you through building robust Excel models for pickup and pasting analysis. Okay, this is the bedrock of all your pricing and inventory decisions. I look forward to seeing you there. Cheers.